Hello and welcome back to Trading Club Q7U course lesson number 21, module 2, Candlestick Masterclass. I'm your lead educator today. Have you ever seen a candlestick chart and wondered what that line sticking out of either side of the candle is? You know, the wick. We're going to break down what it is, why it matters, and how it affects your trading decisions. By the end of this lesson, you'll have a clear understanding of rejection, liquidity, and failed moves. So, let's dive right in. The wick, also known as the shadow, is the line that extends from either side of a candle. It represents the highest and lowest price that the asset traded during a specific period. Imagine a seesaw. The wick is like the seesaw, fluctuating between the highest and lowest prices. For example, let's say you're looking at a 30-minute candlestick chart of Apple stock, and the last candle closed at 150 with a long wick extending above 155. This means that during the last 30 minutes, Apple stock prices reached as high as 155, but the closing price was lower, at 150. Now, let's talk about rejection, liquidity, and failed moves. Rejection is when the price of the asset tries to move beyond a certain level, but can't get past it. It's like trying to push a heavy boulder up a hill. It's just too hard. In the chart, rejection is often represented by a long wick, usually extending below or above the body of the candle. For example, if the price tried to reach 10, but couldn't get through, you might see a long wick below 10, indicating rejection. But how would you identify rejection? Well, let's consider a scenario where the price of the stock reached 8.50 but couldn't break through, resulting in a long wick below that level. This would be a strong indication of rejection, and as a trader, you might use this information to consider shorting the stock. Liquidity is another important factor here. Liquidity is the ability of an asset to be bought or sold without a significant change in price. Think of it like buying a cup of coffee at a crowded cafe. You can easily get it for $2, or whatever the price is. But, if you were buying a rare collectible, it might be hard to find one for sale at a certain price, or it might fluctuate wildly in value. For instance, if the price of a stock makes a big move, but quickly reverses, it might be due to low liquidity in the market. Let's say the price of the stock reaches 12, but then reverses to 11.50, resulting in a long wick above 12. This could be a sign of low liquidity, and traders might want to consider this when deciding their next move. Lastly, failed moves are when the price makes a big move, but can't sustain it. Think of it like trying to run up a hill. You might make a good start, but eventually, you'll get tired and stumble back down. In the chart, a failed move is often represented by a long wick, followed by a quick reversal. But, how do you distinguish between a failed move and rejection? The key difference is that a failed move often results in a reversal of the trend, while rejection is a more subtle indicator of market sentiment. Now, a few common mistakes beginners make. They might overemphasize the wick, thinking it's more important than the body of the candle. Or, they might overlook the wick altogether. To avoid these mistakes, remember that the wick is just one part of the bigger picture. Look at the entire candle, including the body, and consider factors like rejection, liquidity, and failed moves. For example, let's say the candle has a strong green body, indicating a strong uptrend, but a long wick extending below the body. This would suggest that there is still some resistance to the uptrend, and traders might want to be cautious about entering long positions. For your homework exercise, find a chart of a random stock or currency pair, and mark the wick for the last candle. Then, write down 3 things you can learn about the market from the wick. Is it a sign of rejection, low liquidity, or a failed move? Try to identify at least one of these indicators. For instance, let's say you choose a chart of the euro, and the last candle has a long wick extending above the body. Upon closer inspection, you realize that the euro broke through a significant resistance level, resulting in a long wick as the price struggled to sustain the move. This would be a strong indication of a failed move, and traders might want to consider this information when deciding their next move. Now, for a practical exercise,